Great. So now we're moving to our second page, which actually breaks down the performance. And we do have a section where we have performance month on month since inception. And so we give the month and the absolute return that we made in that month. So you can actually just see, okay, this month we did this month we did that, and we put the actual return that we have made in that month. So where I want us to spend a little bit of time is talking about these returns that we've indicated here. Where did those returns come from? So maybe we can slide to the right where we have the asset profit contribution and just sort of discuss where did those returns come from.
Oh, okay. First, I would want to say generally, if you notice, the first months, we had a very big variation in terms of assets that we are managing.
Yeah.
So based on that and the way we calculate the returns, we had very, let me say, varying returns. Because there's a specific formula that we've been given by the regulator in terms of giving returns. And in particular, I would just like to mention in March, we're expecting some huge deposits, which maybe did not come at that moment. And so even in our projections, we are a bit aggressive in how we were trading. And after the deposits did not come, so we ended up maybe surpassing what is called a normal return. So that's why you'll find an outlier in March. Moving to the right, where we look at asset profit contribution, you'll see the various assets and how much of the total profit contribution they've actually contributed. So one, you look at there's a section that you've shown others, which has negative 5%. That shows that we are in normal trading. In normal trading, there is profits, there are losses. Even in the assets that you'll find a positive return, if you go to the individual trades, you'll find that there are trades that maybe made a loss, others made a profit. It's just that the trades that made profits are more or they surpass the trades that made losses.
Okay.
But there are asset classes that you'll find maybe overall we've ended up with a negative. So looking at the negative on others as a trait now, it's actually a section that you are doing options. And what has happened is we have taken up the asset class, but the volumes that we've done are not aggressive enough to have surpassed the minimum charges that counterparty charges us. But looking forward, we expect to increase our volume. And as far as we increase our volume versus the charges for using that facility, we expect to be in positive. Moving on to the second asset class, which is equities. We've not been very aggressive on it as we are looking at the recovery of the local market, but we've been able to make good money.
Let me ask, when you show 2%, for example, in equities, or 10% where indices and metals are concerned,
yes,
what does that mean? Is that the return we've made or the contribution to the total return we've made of that asset class?
This is the total contribution. That means, give or take, if the total profit that we've made for the whole period is, let's say, 30 million.
Yeah.
10% in indices and metals means that 3 million was basically made in that section.
Okay.
While 25% was made in the deposits that we placed with maybe financial institutions in either call or fixed deposits.
Yeah.
Yes.
Okay. What does placement mean?
Placement is actually what we call what we had explained as cash and cash equivalents, yes, whereby you've put money on a call deposit or put money in a fixed deposit with a financial institution.
Yeah.
Yes.
Which is really good. The contribution there is 25%, which
yes,
is it just speaks to where interest rates were earlier this year.
True,
we're getting
true.
like 17.5%, which is so great.
Also, it also skews to our risk. Because what we've done is if 25% of the profits are coming from interest-bearing instruments, that means that also the exposure in terms of risk is lower because interest-bearing instruments are usually less risky. However, we've used the rest of the funds maybe to push now on the bigger trades. Yeah. So the leverage is not so much skewed So we have not over-leveraged our assets, but we've used part of our money just to place on deposits and get consistent, safe, and let me say almost risk-free income.
Yeah.
Yes.
Now that interest rates, I was looking yesterday, and I'm like, was it on Tuesday? I think I was looking at the central bank rates on
Yes.
T-bills, and they have, do you know, just 2 months ago, we
Yes.
were at 17.
Now we are at 10.
Now we're at 10.
Yes.
I'm like, where's return gonna come from?
And that's why we have a special fund. I always say our special fund is an asset allocation fund.
Yeah.
By asset allocation, we skew our allocation based on the instruments that are making money for that period. And with the guidance of the investment committee and the knowledgeable dealers, we are able to skew now to where the income is coming in. Right now, the best place to see income grow as rates come down is what we call capital gains on government securities.
Maybe you can just explain that a little bit, yeah?
Yes.
Like, just how that works. When interest rates come down, then the capital gains go higher.
Okay, I'll give an example. If a bond if you have a bond that maybe you have bought, and we usually say it's a yield. Yield can be almost compared to interest, but it's not interest.
Yeah.
So you're saying that you have bought a bond that is growing at a rate of, let's say, 18%.
Yeah, let's use the IFB,
Yes.
the last nice IFB that was issued at 18.4%.
18.4%.
Yeah.
So you have bought that bond at 18%, what we call yield, or a growth of 18% per year. So after buying it, what happens is, with time, maybe other papers are issued that are being issued at a lower yield. Let me give an example of 15%. So if the government issues a paper or a bond at 15%, and you have a paper at 18%, if you go to the market and tell them that, okay, I have a paper that is growing at 18%, but I'm willing to sell it now at 16%. People will come for the paper at 16% and forego what the government is giving at 15%. Now, based on calculations, because they have to compensate you for the 2% that you are foregoing, it actually ends up being now cash. In your pocket. And that is where you get a capital growth. I would like
So
to
they pay a premium.
Yes.
If it's a 1 million bond, instead of paying you $1 million to get 16%,
Yes.
they're going to pay you, let's say, 1.2 million
Perfect.
for a 1 million bond.
Yes.
Okay.
I would like to compare it maybe with cars. And we've seen that happen, whereby maybe you bought a car 3 years ago, 4 years ago at 2 million. However, now similar cars are coming in at 3 million, such that someone really wants to buy the 3 million car, but they can't afford. So if the cars, let's say the duty is going up and or something of the sort, what happens is the current valuation of the cars, instead of going down, goes up. I know cars, maybe they depreciate because of use and such, but you might find there are instances whereby people have bought cars new at 2 million, and they end up selling at 2.1 because the newer cars are much, much higher. That's a similar thing, but now inversely to what we are discussing about the bonds.
Okay.
Yes.
Okay. So Ian, let's go to the next section, because this next section talks about 1 million. It's a simulation. We had talked about simulation earlier, but this one now breaks down month on month. So just take us through this graph where we're looking at a 1 million simulation on the growth of that money that has been invested, 1 million, from 20th of February to the 30th of November.
Okay.
Yeah, walk us through that.